We're already standing inside stage 5, not approaching it, not theorizing about it. We're in it. And once a system enters this stage, history shows the same sequence unfolds with the precision that feels almost mechanical. 18 months. That's the window between denial and devastation, between markets at all-time highs and families watching decades of savings evaporate. Every empire, every bubble, every great unwinding leaves behind the same fingerprints, the same countdown, the same brutal math that doesn't care who believes in it or who ignores it. Picture your 401k, your home value, your kid's college fund, everything you've worked for stretched out over a cliff edge. The ground underneath looks solid, the view is beautiful, and everyone around you keeps insisting the foundation is unbreakable. But look closer. Tiny cracks, almost invisible, are running through the rock. The same cracks that appeared in 1929 quiet insider selling, sky-high leverage, earnings softening while prices keep rising, and a belief so strong it borders on religious faith. The good times can end. Not now. Not with all this new technology. Not with the Fed behind us. Not in America. But they said the same thing in September 1929. They said it 3 weeks before the Dow dropped 25% in 2 days. They said it while insiders cashed out and the middle class piled in. They said it because hope always blinds people, right when they should be seeing the danger. And that's when the pattern begins. Here's the twist almost nobody understands. The crash of 1929 wasn't a single day. It wasn't one catastrophic moment burned into history textbooks. It was an 18-month sequence, slow, grinding, relentless, that drained wealth from households step by step, month by month, until 90% of the market's value had been destroyed. 90%. And most of that destruction happened before the bottom was even close. That's the pattern you need to understand. Because the same triggers that kicked off that countdown nearly a century ago are flashing again right now. And if this pattern is real and history says it is, then the next 18 months won't just shape the economy. They'll shape your life, the job you keep or lose, the home you stay in or walk away from, the retirement you imagined or the one you're forced into. This is why the 18-month pattern matters. It isn't a theory for economists. It's a survival map for anyone caught in the middle class. It shows you when denial turns into shock, when the shock becomes panic, and when panic transforms into capitulation. It shows you how wealth transfers quietly from those who are forced to sell to those who prepared before the first cracks appeared. And most importantly, it reveals what few people ever realize until it's too late. The crash isn't an event. It's a timeline. And that timeline has a beginning. The beginning is stage 5, the moment when prices disconnect from reality, when optimism turns into delusion, and when smart money slips out the back door while retail investors rush in through the front. It happened in 1929. It happened in 2000. It happened in 2007. And the frightening truth is that all the signals say it is happening again right now. Not next year, not next quarter, now. The biggest question isn't whether the pattern repeats. It's whether you recognize it early enough to act. Because once stage 5 becomes stage 6, the crack, it's too late to prepare. The system enters a self-feeding spiral where leverage unwinds, liquidity evaporates, and the people least able to absorb losses are the ones hit first and hardest. That's what happened last time. That's what happens every time. Over the next few minutes, I'm going to show you the full sequence month by month, phase by phase, starting with September 1929 and ending with March 1931. The 18-month point where most of the devastation was already locked in. Then I'll overlay that timeline onto today, showing where we are in November 2025, what to watch between now and May, what the summer of 2026 could bring, and why March 2027 is the point where the pattern says the greatest damage and the greatest opportunity converge. This isn't about fear. It's about recognition. It's about seeing the structure under the chaos, the rhythm beneath the noise, the pattern powerful enough to repeat itself across generations. And once you see it, you can't unsee it. Because the clock didn't start yesterday. The clock started the moment stage 5 arrived. And that means it's already ticking. Every major financial collapse has a signature, A structure so consistent it feels less like chaos and more like choreography. The moves change, the actors change, but the rhythm never does. And at the center of that rhythm is the same repeating skeleton, the 18-month crash pattern. Not a theory, not speculation, a documented sequence that appears whenever leverage gets too high, valuations detach from reality, and belief becomes louder than arithmetic. It always begins quietly, with stage 5, the everything is fine phase. It's the moment when the surface looks perfect while the foundation underneath is already fracturing. In 1929, this was September. In 2000, it was March. In 2007, it was the summer right before the world cracked open. And in 2025, it's right now. When a system reaches stage 5, the pattern locks into place. You can overlay the past and present like two transparent maps, and suddenly the streets align, the landmarks match, the warning signs flash in the exact same corners. The first month is always the same. The crack, a sharp, sudden break that feels like a fluke, a freak event, an overreaction. People point fingers at a news headline, geopolitical flare-up, a disappointing earnings report. But the truth is simpler. It isn't the trigger that matters. It's the leverage. When enough people are standing on borrowed money, even a small nudge becomes a landslide. Then come months 2 and 3, the most deceptive phase in the entire pattern. Prices bounce. News anchors call it a healthy correction. Analysts insist the worst is behind us. Advisors tell clients to stay the course. And retail investors, good people who worked their whole lives, look at prices 20 or 30% lower and convince themselves they were getting bargains. It's the trap that swallowed millions of families in 1929. It swallowed millions again in 2000, and again in 2008. It's swallowing people even now. Because the dead cat bounce isn't a recovery. It's the inhale before the plunge. Months 4 through 9 are the slow bleed, the grinding collapse that breaks people not financially at first, but psychologically. Every rally fizzles. Every piece of good news lasts 48 hours before the next wave of bad data hits. Unemployment rises, earnings fall, credit tightens, regional banks wobble. People hold on because they were already down too much to sell, and that emotional trap keeps them locked in as the floor drops inch by inch beneath them. And then, almost cruelly, the pattern speeds up. Months 10 through 18 are the point where hope dies. Forced selling begins. Margin calls cascade. Institutions liquidate because they have no choice. Households sell because they're scared or because they've lost their jobs. Banks sell to stay solvent. Funds sell because investors are pulling money out. And when everyone becomes a seller at the same time, there's nobody left on the other side of the trade. That's when prices collapse, not gradually, but in chunks. 10%, 12%, 15%, back to back. This is the phase where wealth doesn't just disappear, it transfers. From leveraged households to cash-heavy institutions. From the middle class to the top 1%. From people who held on because they believed things would recover to people who watched the pattern quietly and waited. It's brutal, it's unfair, and it's exactly what happened the last time stage 5 appeared. But here is the part that should make you pause. The present isn't just vaguely similar to that pattern. It's nearly identical. Record insider selling, executives dumping shares at levels we haven't seen since 2007. Not trimming positions, but liquidating them. Warren Buffett holding more cash than at any point in Berkshire Hathaway's history, over $300 billion waiting on the sidelines. Margin debt pushing toward that same 8% of GDP threshold that preceded every major crash of the last century. Valuations stretched to levels that only show up at the top of bubbles. A real economy quietly weakening beneath the surface, PMIs slipping, earnings softening, commercial real estate crash, and regional banks reporting losses long before the public even notices, and a national mood that mirrors the late summer of 1929 with eerie precision. Everyone believes the big crash can't happen because technology is booming, because AI will change everything, because the Fed will always save the market, because America is too strong, too innovative, too exceptional to fall into the same trap twice. But exceptional nations fall the hardest when they forget the one rule you can escape. Math doesn't negotiate. All 6 signals are already flashing together. Not 1, not 2, all 6. And each of them historically appears only at the start of stage 5, the moment when the countdown begins. That's why this matters. Not because the world is ending, but because if the pattern is aligning again, then the 18-month map that started in May 1929 be the same map we're walking today. Past isn't prophecy, but patterns are probabilities. And this probability is no longer small. Because the pattern doesn't show up randomly. It shows up when societies push leverage beyond the breaking point, when optimism silences caution, and when insiders quietly position themselves long before the public feels the first shock. That's the moment we're in right now. And once the crack hits, whether from a bank failure, a missed earnings report, or a geopolitical spark, the countdown begins. Month 1, then months 2 and 3, then the grind, then the collapse. The same sequence, the same order, the same consequences. And the only way to understand what's coming is to go back and watch how the last countdown unfolded month by month, decision by decision, because that's where the blueprint lives. That's where the roadmap is written. And history didn't hide it. It always begins the same way, with confidence so blinding that nobody notices the smoke until the fire is already beneath their feet. In September 1929, America stood at the peak of its own myth. The Dow hit 381, an all-time high that newspapers swore would be the new normal. Radio hosts celebrated a future of endless prosperity. Economists, some of the smartest in the world, declared that the stock market had reached a permanently high plateau. And yet, behind closed doors, the people who understood the system best were quietly walking away. Joseph Kennedy, already wealthy, already respected, sold everything. Bernard Baruch did the same, liquidating positions, moving into cash and government bonds, ignoring the laughter and the insults. They weren't superstitious. They didn't have visions. They had math. They understood leverage. They saw that when everyone owned stocks on borrowed money, even a small decline can turn into a runaway collapse. They had lived through panics before, and the signs were identical. Corporate insiders were unloading shares at a scale that should have terrified anyone paying attention. Executives selling 50, 60, 70% of their holdings. Not trimming, exiting. They saw earnings peaking. They saw orders slipping. They saw commodity prices weakening. They saw the real economy rolling over months before a single headline mentioned danger. The public, meanwhile, kept buying because prices only go up until they don't. European money fled first. British banks sold American stocks all through August and September. They had seen this movie before: the South Sea bubble, railway mania, every speculative fever that begins with euphoria and ends with ruin. They recognized valuations that no longer made sense. They recognized a market running purely on belief. And that is the signature of stage 5. The moment when price becomes a story instead of a reflection of reality. Then came October 1929, month 1, the crack. At first, it felt like nothing. Choppy trading, higher volume, a few sharp down days followed by recoveries. But to professionals, heavy volume at the top isn't enthusiasm, it's distribution. Smart money selling to anyone still willing to buy. Friday, October 18th, a sudden drop. It recovers. Monday, the 21st, another wave of selling. Tuesday, the 22nd, more weakness. Wednesday, the 23rd, panic starts. By midday, the titans of Wall Street rush to J.P. Morgan's library, Lamont, Wigan, Mitchell. They announce a rescue pool. They buy stocks. The market rallies. Newspapers celebrate. The bankers save the market. But overnight, thousands of margin calls go out in the mail. And when people opened those letters on Monday morning, everything changed. October 28th, down 13%. October 29th, down another 12%. In 2 days, a quarter of America's stock market vanished. But here's what almost nobody understands. That wasn't the crash. It was just the crack. Just the moment when leverage began unwinding. Just the first domino tipping over. The real destruction was still ahead. November and December 1929, months 2 and 3. False hope. The market steadied. It bounced. The same newspapers that screamed fear in October switched back to optimism. Correction over. Fundamentals strong. Stocks attractively valued. Brokers urged clients to buy the dip. Families who sold during the panic regretted it, thinking they'd overreacted. People still holding felt vindicated. But beneath the surface, the bleeding had already begun. Banks were absorbing losses quietly. Borrowers who bought stocks on margin couldn't repay their loans. Banks began restricting credit to preserve capital. Businesses felt the squeeze. Orders declined. Layoffs began. It was small at first, almost invisible, but it was the start of the doom loop. Falling markets, bank losses, credit tightening, business slowdown, job losses, mortgage defaults, more bank losses, more fear, more selling. Meanwhile, the public focused only on the bounce, convinced the recovery was underway. Then came January through June 1930, months 4 to 9. The grind. This is the part of the pattern few people study, because it isn't dramatic. It's worse. It's soul-crushing. The market didn't crash, it sagged. Slowly, relentlessly, down 5% one month, 3% the next, a tiny rally, then another slide. You could almost hear hope being stretched thinner each week. At dinner tables across America, the conversation changed. Factories were cutting shifts. Commodity prices collapsed. Farmers couldn't break even. Wages were reduced. Regional banks, hundreds of them, failed quietly, wiping out entire communities' savings. No FDIC, no safety net. One day, your money existed. The next day, it was gone. By June 1930, the Dow had dropped to 220, down 42. Yet still, the public clung to optimism. They kept waiting for a rebound. They kept telling themselves it couldn't get worse. But it did. July 1930 to March 1931, months 10 to 18. Capitulation? This is where the pattern revealed its sharpest teeth. The slow bleed snapped into a waterfall. Prices fell not in inches, but in whole floors. 15% in July, 12% in August, 18% in September. Funds liquidated because investors demanded their cash. Banks sold to stay solvent. Households sold because they had lost their jobs. Institutions sold because they had no choice. And when everyone sells at once, buyers disappear. By November 1930, the Dow hit 180. By February 1931, 160. 18 months after Stage 5 began, the market was down 58%, and the true bottom was still a year away. Outside the markets, America cracked open. Unemployment soared to 15%. Industrial production collapsed. Construction froze. Breadlines wrapped around city blocks. Churches ran out of food. Families built shelters from scrap metal and cardboard. Hoovervilles rising like scars across the country. And through it all, a quiet transfer took place. While the middle class sold in fear, the wealthy, who had exited early, began buying everything: stocks, land, businesses at discounts of 50, 60, 70%. Joseph Kennedy, who stepped out before the crash, stepped back enduring the ashes. By the mid-1930s, his wealth had multiplied several times over. This is the part history textbooks sanitize. Crashes are not destruction. They are redistribution. They move wealth from the hopeful to the prepared, from the leveraged to the liquid, from the many to the very few. And the blueprint that governed 1929 to 1931 is the same blueprint the market follows every time the world enters Stage 5. Which is why going back through this timeline isn't nostalgia. It's preparation. Because the map you just walked through didn't end in 1931. For us, it may be starting again in 2025. History feels distant until it suddenly looks like your bank statement, your rent payment, your job security, your retirement account. The 18-month collapse from 1929 to 1931 isn't just a relic, it's a mirror. And when you hold that mirror up to November 2025, the reflection is unmistakable. The storyline has new characters, different technology, modern headlines, but the emotional arc, the mathematical pressure, the pattern underneath. It's the same script running again. Right now, in this moment, we're standing exactly where America stood in September 1929, at the top of a market that looks invincible while the real economy quietly frays behind the curtain. Stage 5 then. Stage 5 now. Insiders sold aggressively in 1929. They race selling even more aggressively in 2025. Warren Buffett hoarded cash before the last two major crashes. He's holding the largest cash pile of his career today. Margin debt hit 8% of GDP before every historic plunge. We're brushing that level now, 7.9% and rising. Valuations soared far beyond fundamentals back then. They're doing it again, with the Shiller P/E ratio sitting in a zone that historically only appears at the top of bubbles. And the psychology? Maybe the most dangerous similarity of all. In 1929, people believed America had entered a new era of prosperity, untouchable by old rules. In 2025, people believe AI, innovation, and the Fed have ended the business cycle. That optimism is beautiful and lethal, because the moment people believe markets can't fall is always the moment markets are most vulnerable. This is why the overlay matters, because once you place the 1929 to 1931 roadmap on top of 2025 to 2027, the alignment is almost mathematical. November-December 2025 is month 1. The pre-crack window, the calm before the fracture, the last chance to de-risk before leverage fires the first shot. A single earnings miss, a geopolitical spark, a bank wobbling in the wrong week, any of it could be the nudge that sets off forced selling. And when leverage is this high, the nudge is irrelevant. The reaction is what matters. December 2025 to January 2026 becomes months 2 and 3. The dead cat illusion, the moment that will trick millions. A sharp decline, then a bounce strong enough to feel like redemption. The news will sound positive. Analysts will call it healthy. People will breathe again. That's what makes it so dangerous. Because this bounce is how the pattern pulls people deeper, giving hope right before it takes everything. February to June 2026 is months 4 to 9. The grind that breaks people slowly. This is the phase middle-class Americans never forget. Not because of the headlines, but because of the personal impact. Layoffs begin in waves. Credit tightens. Mortgages become harder to refinance. Small businesses feel the first cracks in cash flow. Friends lose jobs. Neighbors fall behind on payments. You hear it in conversations at the grocery store. You feel it when your paycheck doesn't stretch as far as it used to. You watch your retirement savings bleed out little by little. It's not dramatic. It's suffocating. A slow erosion of stability. And just like in 1930, the stock market doesn't collapse all at once. It drips downward, month after month, humiliating every attempt at optimism. A small rally fizzles. A bit of good news dies within hours. By mid-2026, the emotional exhaustion is more devastating than the losses themselves. People aren't just scared, they're tired. That's when the pattern tightens its grip. Then comes July 2026 to March 2027, months 10 to 18. The capitulation window, the place where the pattern does its real work. Unemployment spikes 12, 13, maybe 15%. Corporate bankruptcies spread from small firms to names people once assumed could never fail. Commercial real estate collapses in slow motion. Office towers empty out because companies can't afford the space or no longer exist to fill them. Regional banks begin to wobble, then fall. FDIC funds strain under the pressure. Credit markets seize. Lines at bank branches grow longer, and political anger ignites like gasoline. People won't call it panic at first. They'll call it uncertainty, then instability, then crisis. But by the time the word panic finally appears in headlines, the capitulation has already begun. Households forced to sell, funds redeemed into weakness, institutions liquidating portfolios to stay solvent. The market loses buyers and keeps only sellers. Prices fall in chunks, 10% here, 12% there, 15% overnight. The same way they did in 1930. The same way they did in 2008. The same way they always do when leverage breaks. And the eerie symmetry continues. The 18-month mark in 1931 landed near 60% losses. The 18-month mark in May 2027 do the same. The wealth that vanished for millions in the early 30 seconds reappeared on the balance sheets of the few who had liquidity. The same transfer is building now quietly, invisibly, methodically. Because while the middle class sells under pressure, the wealthiest institutions wait like they always do for chaos to make everything cheap. They don't chase bubbles. They don't buy dips. They buy capitulation. And the timing lines up with an almost uncomfortable precision. March 2027. The 18-month mark. The point in the pattern where the most damage is concentrated and the greatest opportunities emerge for those who survive the descent. This is not about doom. It's about recognition. Because once you accept that the same structure is forming again, you stop asking, will it crash? And start asking something far more important. When the pattern completes, which side of the transfer will I be on? When you step back from the noise, the charts, the headlines, the political arguments, what emerges isn't chaos, it's architecture. Crashes don't appear out of nowhere. They don't strike like lightning. They unfold like seasons. Slowly at first, then all at once. And every season leaves behind the same lesson, written in the same unchanging language. The people who survive are never the people who react. They're the people who prepare. That's the real story of the 18-month pattern. It isn't a prophecy of doom. It's a blueprint for survival, and, for a disciplined few, an opportunity to build the kind of wealth that lasts not 5 years, but 5 generations. Because every collapse in history, from Rome's currency debasement to Spain's silver glut to Britain's imperial overreach to America's own 1929 meltdown, has followed the same rhythm. Leverage rises, optimism blinds, math breaks, and owners of cash step forward when everyone else is on their knees. The only variable is which side people choose to be on. And that choice begins long before the final plunge. It begins in phase 1, the moment before the crack, when the market is calm, when headlines are optimistic, when people feel confident, when nothing looks wrong. That's the moment when de-risking feels unnecessary, even foolish. But that's when it matters most, because protecting your capital before the crack is infinitely easier than recovering it after. Then comes phase 2, the most seductive trap of all, the bounce after the first decline. The moment when people say, see, it wasn't so bad, and rush back in. But that bounce is foam on a sinking ship. It's a gift for sellers, not a signal for buyers. It appears every time before the real damage begins. Phase 3 is the test of patience, months of grinding declines, the slow erosion of confidence, the exhaustion that makes people sell not out of strategy, but out of despair. This is where the middle class historically loses the most, not because they panic first, but because they hold the longest. They hold through loss after loss, waiting for a recovery that never comes. And by the time they finally surrender, the worst is still ahead. And then the pattern enters phase 4. The moment of capitulation, the point where fear peaks, where news headlines feel apocalyptic, where layoffs surge, where entire industries buckle, where households sell whatever they have left simply to stay afloat. It's the phase people fear the most, but it's also the phase where generational fortunes begin. Because the truth is brutally simple, the bottom isn't where wealth dies, it's where wealth changes hands. In 1931 and 1932, when America was drowning in despair, the families who had waited with cash stepped in. They bought railroads, land, factories, entire companies at pennies on the dollar. Not because they were reckless, but because they understood the pattern. They understood that the world always feels like it's ending right before it begins again. And when they deployed their capital slowly, steadily, courageously, they didn't just profit. They changed the trajectory of their families for generations. The same thing happened after 1974, after 2000, after 2008. Every crash is a transfer from the emotionally driven to the strategically patient, from the leveraged to the liquid, from the unprepared many to the prepared few. And now, standing in November 2025, facing the same stage 5 signals that preceded every great unwinding of the last century, the same choice sits in front of anyone paying attention. Not a choice between optimism and pessimism, but between reaction and preparation, between hoping the storm passes and positioning yourself to emerge stronger after it does. March 2027 isn't guaranteed to be the exact moment the pattern completes. History doesn't repeat with calendar-level precision, but it does rhyme with uncomfortable accuracy. The 18-month window is where the math concentrates the destruction and amplifies the opportunity. It's the zone where fear peaks, forced selling erupts, and the people who plan quietly step forward. And here's the unfinished truth you need to carry forward. The next 18 months will define the next 18 years of your financial life. Maybe more. Your decisions now, how much risk you carry, how much cash you hold, how calmly you navigate the grind, how courageously you act when others break, will determine whether you are forced to sell at the bottom or positioned to buy it. The pattern isn't destiny, but ignoring it has a cost. Seeing it has a reward. And as we move through this cycle, month by month, phase by phase, the question won't be whether a crash happens. The question will be where you stand when the dust settles on the side that lost everything, or the side that patiently rebuilt wealth while the world was looking the other way. The clock is already ticking. The transfer has already begun. The next move is yours.